Right, the second question we're doing here, you can see, was sourced from the October-November 2011 paper. It was for 45 marks, 54 minutes, and we'll start off again by reading the required. And we see again, it's one of those tougher questions where they just say, disclose everything insofar as it relates to the above. The only things you can leave out: accounting policies, deferred tax balance, all of your income tax expenses, and you don't need to show any of that IFRS 7 financial instrument disclosure. So none of the risks and none of the current, non-current portion for the lease liability. Right, looking at the fact pattern then, we have this company, Peter, that bought equipment quite some time ago, so on the 30th of June 2008 for 1.3 million, and there were transaction costs incurred in acquiring that PP&E, which would be capitalized, 26,000 Rand. Then the company depreciates straight line, as does SARS, so no deferred tax, and that is straight line over 5 years. Government gave us a grant as a direct result of acquiring that machinery, so that was for 195,000 on the same day as we acquired the machine. Then they tell us that these asset-based grants, that's what that one is, are treated as deferred income. So we're not going to reduce the carrying amount of the asset by the government grant. We're going to keep the government grant as deferred income and recognize it in profit or loss as income over the life of the asset. Then, in order to improve cash flow, we entered into a sale and leaseback transaction. That was on the 1st of May, and we acquired the asset, or we sold it, and then for 850,000, and then leased it back again. All right. The lease term is as follows. It's 3 years. Those are the installments. Payments are made 6 monthly, starting 1st of October, so that's in arrears, and that's the last payment made. So you can see those are the items there that you need to disclose in that finance lease note. Ownership will transfer. That's telling you it's a finance lease. In fact, I didn't know until then that it was a finance lease. And legal fees of 15,000. So those are those initial direct costs which will capitalize to the carrying amount of the asset. And then, due to the fact the sale and leaseback was entered into, government has made us repay 15% of that grant that we received. This repayment has to take place on the 1st of May 2010. So that's going to affect the deferred income on this particular government grant agreement. So once again, visualizing the required as a result of all of that, I should think that you would be able to ascertain you need a profit before tax note. And then just thinking ahead, the incomes over there are going to be the deferred income on the government grant realized. There's also possibly going to be that deferred income on the sale and leaseback realized. Leave some space in case we pick up other incomes. I don't think I saw any. And then expenses, we're obviously going to have, well, depreciation. And we're going to have the finance charge or the interest expense on the sale and leaseback. All right, I'm not sure if there's anything else. We'll see as we go. And I'm going to make some space here for some workings. And just to show you that very often what you can do is you have those double pages in the exam. So it's a good idea to have a really pretty answer on the left-hand page and all your workings and squiggles and references on the right-hand page. We're also going to need a note for property, plant and equipment. So that item of property, plant and equipment starts off by being an owned asset, ends up being a leased asset. All right. And we'll have the normal story: opening balance, movements, closing balance. Then as far as the finance lease is concerned, we'll write out the terms and conditions. If you don't mind, I'm not going to write those out in the interest of time, but you would write those out, and then you would you wouldn't need that current, non-current portion in terms of IFRS 7, but you would need the reconciliation of the minimum lease payments to their present values. It'll be for the next 1 year. Let me give myself some more space. For the next 1 year, 2 to 5 years, and then a total. Normally I don't add up the total, but because of time, but you should add up that total as well in the exam. And let's give ourselves space here for some workings on that. Right, then we'll also need a note for the government grant. So we're going to have a note for the, well, let's start, sorry, the deferred income on the sale and leaseback, and then one for the deferred income on the government grant. All right. And I'll just give myself some working space there, and I think we're ready to go. So looking at the asset, I think a timeline is going to be of the essence. Let's do that, and I've got my reporting date, which is the 31st of the 12th x 10, and then your beginning of year, which is 1 January x 10. We entered into the sale and leaseback on the 1st of May, so that's over here somewhere. 1 May, that's the sale and leaseback transaction. On that day also we have to repay part of the government grant. Back here somewhere, let's see when that was. Correct, the 30th of June, that is. On 30 June 08, we acquired the asset. So just very quickly, 30 June 08 till the end of the year is 6 months, and then until the beginning of the year is 12 months, and then that is 4 months, and that is 8 months. And I need that to work out the depreciation just now. All right, I think that's just about everything that happened, hey? Oh, and then 31 October, over here, 31 October, we make our first lease payment. All right, so I think I'll be ready to go now as far as that's concerned. Let's do the asset first of all. So I'm just quickly going to do a quick little calc. In fact, you know what? I might as well do it on the note because that'll save me some time. So my property, plant and equipment, I've got the carrying amount on 11x10 made up of cost, and let's see, that was 1.3 million, the cost. 1.3 million and 26 transaction costs. Okay, plus 26 transaction costs. All right, so 1326000. Then I would have accumulated depreciation on that. So let's do a little calculation for that at the beginning of the year. So that's going to be on the 1326 times by useful life was 5 years, which is 60 months. And then until the beginning of the year, let's see, I've got 6 and 12, that's 18 months. All right, so we'll work out depreciation on that. 1326 times 18 over 60 is 397,800, which gives me a carrying amount of 928,200. All right, then I've got to depreciate this asset. So depreciation for the current year, but I'm only going to depreciate it for the first 4 months of the current year. So 928,200 is my carrying amount at the beginning of the year, and then times 4 over, and the remaining life would have been 42 months because it's been used for 18 already. There were no changes in estimates, so you could have simplified that, but that's the better way to do it. And that's going to be 88,400. Right, so I'm going to have depreciation of 88,400, and then I'm going to transfer this asset to leased assets, which is an amount of 839, it's just the balancing figure, 800, to leave me here with nil, and then 839,800 is the carrying amount of the leased asset. Right, then, and I think as a working, if you don't mind, I'm going to do the journals for the lease. So then what's going to happen is we enter into the lease, debit bank, credit lease liability, and that was, well, let me check there, 850,000, I think. Indeed it was 850,000 on the 1st of May. So that would be 850,000. Then we obviously transferred the asset from owned to leased, and the amount we transferred, let's just check it out, there was 839,800. Hey, 839,800. Just in the interest of time, I won't write that entry down. I've already done that. And then what we need to do is compare the carrying amount to the selling price, and if necessary, revalue the asset. So I do need to do that. So I'm going to debit my leased property, plant and equipment. And what's that difference? That is 10,200. And I'm going to credit this deferred income 10,200. All right. So I can quickly pop that on my note because the asset's going to go up by, so there's the, should we call it, yeah, deferred income, I think. Deferred income. That's a reval in terms of IAS 17. It's actually not a PPE reval. All right, so that gives me that amount. Then I'd need to capitalize initial direct costs to the asset. So that was, I think, 15,000 we read there. Yes, it was. We had to pay 15,000 legal fees. So initial direct costs capitalized 15,000. That gives me 865,000. 15. And then the next two things I'd need to consider on the lease, just the order in which I like to run through things in my head, was I would then depreciate the asset. I would realize the deferred income. And then when I made my payments, I would have gone debit interest, debit liability, credit bank. Okay, so the depreciation we might as well calculate here. So let's make that calculation 4. That's going to be 865,000 multiplied by 8 over, and then the useful life was 60 minus 18 minus 4 for the first part of the year. So 60 minus 18 minus 4 is 38 months. So 865,000 multiplied by 8 over 38 is equal to 182,105. So we'll have more depreciation here, 182,105, and that'll give us our carrying amount at the end of the year, minus 865 of 682,895. And then the way I normally do it is I say, well, the deemed cost of the property, plant and equipment is 865, so I'm just going to pop that in there, 865, and the accumulated depreciation of 182,105. What you can do there as well, though, is you could have kept track of the original cost. So you could have put the cost in as 1326000 plus the amount we revalued 10.2 plus the 15,000, and then just put the balance in as accumulated depreciation. I don't think there's a right or wrong there, so either way I think will suffice. So that's the depreciation on the asset. What did we work out there? Well, whatever we worked out, we've done it already. And then we've got the deferred income. That's simple enough. That's going to be, calculation wise, it's going to be the 10,200 over the lease term, which is 3 years, times 1/3 times 8/12. Simple enough, eh? 10,200 divided by 3 times 8/12 gives me 2267. 2267. 2267. So the marks for that, if you don't mind, in my PBT note, this is 2267, and let's call this working 1. That's A, B, C, D, E, F. So E it was, eh? Working 1E. Right, then we've got the depreciation. Let's not forget to put that down. That was the two numbers, was 88,400. 88,400. Plus there was another 182,105. 182,105. And then we'll say, go and see the PPE. And what calcs were those? They were 3 and 4. Okay, so PPE 3, PPE 4. I'm sure the examiner will find that just fine. Right, then we've got the payment. So for that, I would need to just go and do my little PV calculation. So I've got a future value, I've got N, I've got I, I've got my payments, I've got my present value. The future value they've told me is 0. My N is the number of installments, that's 6. My I they did not tell me, so you'll need your financial calculator to compute that. Your payments were or are 175,583, 175,583, and that has to repay that loan of 850,000. Okay, so let's do that. We've got 0 as our future value, 6 as our N, 175,583 negative, because we've got to pay that out, is the payment, and then 850,000 as the present value, and what you're going to compute is I, and I get 6.5%. Please understand that is the nominal rate per 6-month period. All right. What we've got to disclose in the financials is the effective rate. So to convert that to an effective rate, that is 13% per annum. I just multiplied by 2. And then, I don't know if you can remember how to do it, but hopefully you can. I need to convert that from nominal to effective, and there are 2 payments per year. So what you're going to tell your calculator is that if 13 is the nominal rate and there are 2 payments per year, what is the effective rate? And that effective rate is 13,4225. Okay, I can't really get into a financial calculator lesson, so if you don't remember how to do that, please just have a little revisit or drop me an email or something, and maybe I can help you with that. Right, so that's going to be the effective rate that I need to disclose. And then what happens in the current year is I've got 1 payment that happens in the current year. And so at 1 amort, and let's might as well just do that here. So using those inputs at 1:1 amort, I get capital, interest, and balance, and the calculator will just spit those out at me. So I'm going to just ask it for that. And the capital is 120,333. The interest is 55,250, and the balance is 729,667. So using those, what should we call this? We'll call this working 2, and then I think we'll just reference this. Let's call that A, let's call that B. Okay, so we've got working 2B, call this C. So we've got 120,333 and interest of 55,250. Right, so let's go and get those marks. So we've got for the interest, that is anyway. So for the interest expense, we've got 55,250, and we're going to tell them working 2B. They can go and have a look there if they want to see how we got that. And then also, we need to accrue for a bit more interest, right? So that's the first time you're seeing this one. So what happens is we've made our last payment up to 31 October. What about the interest incurred from there to there? It's just a simple accrual. So that is October, November, December. That's 2 over 12 months. So what I'm going to do is accrue for interest for 2 over 12 months. Right, so that is going to be, I'm going to take the balance on my loan, which your calculator gave you. That was 729,667. Balance equals that. And then simply times the interest rate of 13% per annum times by 2 over 12. And what I'm going to do is debit interest expense and credit the liability. 15,809. 15,809. Okay, so let's add that to the interest. 15,809. Okay, so 55,250 plus 15,809. That was working 2B, and that was working 1EFG. All right, so that would be your total interest that we need to present or disclose. Right, then the rest of this is going to be the minimum lease payments. So what we're going to do is show the minimum lease payments, and let's go back to our timeline and look at next year, or maybe let's draw a new little timeline because that's a little bit tricky. I'll run out of space there. So if there's the 31st of December x10, so we had October, November, December, January, February, March, April. So in April there's a payment, October there's a payment, then another year end, 31/12/11. Then April there's a payment, October there's a payment, then a year end, 31/12/12. You get the picture. So what's going to happen next year is next year we are making payments. This is going to be payment 2, that's going to be 3, that's going to be 4, 5, and so on. So when you do this little calculation over here, all right, we're going to say 2 payments, okay, and you would need to show the working. Let's see, where shall I do that? I just need a bit of space. I don't have much space here, so I'll just do it down there. You would fit this on the opposite page quite easily too, I'm sure. And what you would have there is so you would have 2 times the payments of 175,583 is 351,166, and then 3 payments of 175,583 is 526,749, because you appreciate you're going to pay payment numbers 4, 5, and 6 in the next 2 to 5 years. Then what we need to do is we need to break that down into our interest and the PV. Now here I have a difference of opinion with you, Nisa, but I want to show you obviously how to get the marks. All right, so the interest, all right, I think you'll agree is going to be for 2 to 3 amort. All right, and for 2 to 3 amort, we are going to get, let's give myself a bit more space, we're going to get the, so for 2 to 3 amort, we're going to get the interest, the capital, and the balance. So let's ask the calculator for that. Starting at 2, input, ending at 3, amortize for me, and the capital is 264,639. The interest is 86526, and the balance is, so let's get rid of that. The balance is 465,027 for payments 4, 5, and 6. The capital is 465,027. The interest is 61,722, and the balance is going to be 0. And those are the numbers I would put in. So for my money, what you've got to do is you're going to say the interest is that, which is 86,526, and the interest here is 61,724. And as far as I'm concerned, that gives you the present value, the capital portion, and that's where I would end it. UNISA ever do this, and they take the opening accrued interest and the closing accrued interest. So what they're going to say is that the interest accrued from last year, okay, must be taken out, and we've already done that calculation. It's 15,809. And then what you can calculate is at the end of that period, the balance would have been 465,027, and the interest on that at 13% for 2 over 12 is going to give you 465,027 times 0.13 times 2 over 12 is 10,076. 10,076, which is the opening balance here, 10,076, and at the end of the lease you'll owe nothing. All right, so what they do is in this interest they make those adjustments as well. All right, I beg to differ, all right, but that's the way that I know that you're going to get the mark, so please do it that way. Obviously it makes sense. Minus 15,809 plus 86,526 gives you 80,792, okay, or 793. And then in that period over there, 225, the capital is going to be 526,749, and then the interest is 61,724 and 10,076. So they're just going to work it out like that. No big deal. All right. That takes care of the lease liability. So I think just to finish off then, let's go and do the deferred income note. That's going to be fairly simple. So what I'm going to do, we only have to show the current, non-current portion, but I always just give a little bit of hard came about. So I'll tell the user the asset at a setting price of 850. It had a carrying amount of 839,800 if my memory serves me correctly, and that gave rise to this deferred income of 10,200. During the current year, we realized part of it. It was 2,267, which means we've got a balance of 10,200 minus 2,267 is 7,933. So that's your balance. And then you're going to show that balance made up of current and non-current. And the current portion is just going to be 10,200 times 1 over 3, because that's how much will be realized next year, and the balance thereafter. So that's going to be 3,400, and your non-current portion then 4,533. All right, fine, we're almost done. The deferred income, I'll have to go to back to the beginning there as well. So government gave us a grant. Back then that would have been debit bank credit deferred income, and that was an amount of 195 that we were given. Yes, it was 195. Oops, there we go. 195,000. Then what would have happened is we would have realized the deferred income. That looks like this. We would have gone debit deferred income and credit income on the government grant, and that you show in profit or loss as other income. And looking at our timeline, you would have done that for, just going back to refresh your memories, you would have done it for 6 months and then 12 months up until this year. Okay, so 6 months and 12 months up until this year. And you realize that on the same systematic basis as your depreciation. So have a close look here. You're going to take 195 times 18 over 60. That's exactly how we depreciated the asset, remember? And then 195,000 times 18 over 60. I'm just doing, that's what would have happened in the previous years, 58,500. Right? Then what would have happened in the current year is we had to make this repayment. Right? Now, knowing that you have to make the repayment means that you know now that your government grant wasn't really what you thought it was. So if I go back here and I say, right, we've got to repay 15%, that's easy enough. We're going to debit government grant, credit bank, or deferred income bank, with 195,000 times 15%. So that's 29,250. All right. Now, if you want to compare that, then that means actually after the repayment we only really got a government grant of 165,750. All right, and if you wrote that off over 18 over 12 times 18 over 60, I beg your pardon, then this would have been 49,725. All right, and in any given year, for example this year, we would have debited deferred income, credited profit or loss, and that calculation would have been 165,750 multiplied by 12 over 60. Um, 165,750, that gives you 33,150. 33,150. And that's how we're told to do it. So we're told to do what we call a cumulative catch-up change in estimate. And when you do cumulative catch-up, you base everything on the estimate as if you always knew about the repayment. The only problem is you can see this figure here in years gone by was overstated, wasn't it? So 58,500, difference between that and 49,725 is 8,875. So what you do is you correct that, but not in the prior year. You correct it in the current year. Minus 8,875. Minus 8,875. 8875. So that was 8875, that difference. All right, so your government grant's going to look like this. So you've got the opening balance, which we had at, let me just subtotal it here if you don't mind, it's 195,000 minus 58,500. We would have had 136,500 as the opening balance, 136,500. Then we had to repay 29,250, which meant that the amount we realize every year is going to be less. So what we realize this year is the number we've got there, 33,150, but also that cumulative catch-up change in estimate, 33,150 minus 8875. So 24,275 is what you would have realized this year. So your balance is 82,975, and just like we did with the deferred income on the sale and leaseback, we would have to split this up between current and non-current. And I think you'll agree that the current portion is simply going to be the 165,750, all right? And next year, 12 over 60 of that will reverse out. 165,750, the restated amount, if you like, times 12 over 60, that is 33,150, and the rest, minus 82,975 is 49,825, will be the non-current portion. Last thing I need to do is just have a check that I didn't leave anything out of profit or loss. So that's correct. That's done and dusted. So is that, and it's all totaled off. So I've just got this here, the deferred income government grant realized, and all the way back here, that was 24,275. It was 24,275, and I'll tell them to go and look at the government grant note, because that's where I did the calculation, and no doubt they'll be able to find that. My depreciation I would add up and put there, my interest expense I would add up and put there, and it seems as though that's all they asked for. So not a bad question. A couple of technical little bits like that interest accrual, guys, you've got to just understand that that's for the special children, eh? Special kids, and you can go and get your 80-90%. Believe me, that missing out on that will never ever be a pass or fail issue. All right. Yes, it might stop you from getting 80 or 90%, but it certainly won't stop you from passing the question. And you see what I did there again is I thought in product. As soon as I read the required, a picture formed in my mind, and that's because I know what these notes look like, and so should you. And then what I did is I went and populated the notes, okay, using calculations to back up those figures. All right. No point doing just calculations or just notes without calculations. You need the two to go hand in hand, and where necessary, you need to reference. All right. If you get the figure correct, you get full marks. If you get the figure wrong, you get no marks, unless that particular wrong figure is referenced to a working, and then the marker will go and mark that working.